Starting for the session for today. Today we will be revising FR, and we are looking to revise the entire FR, and it will be a quick revision. We're looking to do it in 1 hour 15 minutes to 1 hour 20 minutes. That is the target with which we are starting off with the FR revision. Okay. As I mentioned in the previous session also, it's going to be a quick revision because it is a pre-exam total review session. So it is needless to say that you would have watched the detailed videos, masterclass recordings, or if you are part of our live online class program, and you would have covered the revision videos, the crash course videos as well. And now it is like you are just giving a quick brush up or a quick recap to the everything, and that is why this video is basically that is what is the purpose of this particular quick revision. Okay. We are doing income statement from my main recording or main PPT because income statement has some changes in 2022, and after that we will switch back to our quick sheet and our revision mat for other things, because there are no changes after in those portions. Okay. So income statement. Okay. Income statement is something which is very simple to understand, which is basically revenue minus expenses income statement. So it is a presentation of during the year. Income statement is always for the year, and during the year how the business has performed and how they are able to how we are able to perform that. Okay. How much profit we have generated, that is what income statement gives us. The difference between income statement and balance sheet is that balance sheet is always as that means that suppose business has started 10 years ago, 15 years ago, 100 years ago. So in 100 years, how much business was able to do, that is called the balance sheet. Balance sheet gives you the as at date, that since the date business started to the date the business was functional till the date on which balance sheet is prepared, what assets business accumulated, what liabilities business incurred. While income statement is always a annual concept, that is for the year. So this year's revenue, this year's expenses, all those will only come into play. Okay, this is the difference. Then always we have two set of presentation, US GAAP and IFRS. Now there are certain differences which you have to understand. US GAAP presentation differences, this is something which is only difference thing you have to understand is that a separate income statement with changes in OCI is not allowed under IFRS, but it is allowed under US GAAP. What is CI and OCI? CI stands for comprehensive income, while OCI stands for other comprehensive income. Okay. Comprehensive net income captures everything except for certain four elements which is captured in OCI, and together they form the comprehensive income. We'll come to that a bit later. Okay. Now this is a ideal format or a real life presentation of an income statement as per US GAAP IFRS. I'm not going into detail because you are supposed to know this particular thing. Okay. The basic definitions of revenue is something which is known, but still revenue is the total goods, total amount received or receivable. So basically accrual concept. Accrual and cash concept difference is something which you should be aware of. We always try to follow accrual concept, which is that it is immaterial of whether cash is received or not, but when we have provided the services is something during that period you would be recognizing the revenue. So yeah, that's why they say received or receivable in exchange of delivery of goods or services in the ordinary activities of the business during the period. Okay, ordinary activity. So that is what is revenue will be called, which comes from your normal course of business. Suppose I am a furniture seller. I'm a furniture seller, and if I go and sell plant which is there in my factory, so that is not my ordinary activity. My normal business is to sell furniture. If I get revenue from selling furniture, then only it will come. If I sell it from other than selling furniture, other than my normal, it will be called as extraordinary income. What is called extraordinary income? It will not be forming part of revenue. Okay. Then next is gross profit or gross margin. What do you mean by gross profit? It's basically minus all the direct costs. What are the direct costs? Something which directly goes into the manufacturing of that product, raw material, labor, overhead, etc. All these are direct costs. What is indirect cost? All these which direct and indirect cost means all these which are ancillary to the support, which supports the preparation or work of that particular production of that thing, but which does not directly go into that. For example, electricity. For example, factory rent. For example, you can say the salary paid to the office staff. So they are ancillary, but they are not directly producing the product. Okay, that is indirect cost. Net income is deducting all the direct, indirect, interest expense, finance cost, everything, and taxes. Non-controlling interest is basically minority interest, which holds a very small percentage in the company, and that they hold a very small percentage, and that's why they are called minority interest. Suppose I hold 99% shares and someone else hold only 1% share in a company. That 1% is called minority interest. This is a customized table I prepared. I told that you will not find it anywhere. So this is basically something which you all you would have seen basically as part of the program, so that's fine. It's a normal income statement format, and grouping of expenses is something which is normal. IASB definition. Now coming to revenue recognition, this is our second part. Okay, at the very start I told that we have divided our entire discussion, because this is a very lengthy reading, so we divided it into 5 parts. One is introduction, we have covered that. Next is revenue recognition, expense recognition, and then we have EPS calculation and residual. Okay, so now we are at revenue recognition. Revenue recognition concept has been simplified. So they say that how revenue is recognized. Revenue means income. Income is equal to revenue plus gains, basically. So what is the definition of income? Anything which is revenue, that is normal business. Gain, that is means when you sell, enhance a asset or decrease a liability, and during that period you incur a gain, both will come under the definition of income. Okay, accrual concept, we all know that what is accrual concept. Core principle of recognizing revenue of the converged standard. I said that convergence of standard has occurred, that's why this particular reading has changed, because there is a accounting standard change. Okay, what are the accounting language, what are the normal 5 things that you should see? Basically, for whom, simplified language I'm saying, for whom, basically for whom you are preparing, so there should be clearly identified in any contract. Okay, what to do, that is what is the purpose, why you are receiving the revenue, how much you will get, pay per work, that means the transaction should be divided, that okay, for this particular part you have this much, this particular part you have this much, and revenue recognize revenue when or as the entity satisfies the performance obligation. That means accrual concept, when your service is performed, not when you have received the money, it is immaterial. Okay, next is contract, and these definitions of contract, this is something which you can go through. Condition 1, when should we recognize the revenue? Important thing, number 1, collectability has to be there. That means it is highly probable that you will receive the money. Suppose if there is an end date, there is a debtor from which you are expecting a money, but you don't believe that that person will be able to pay because he is bankrupt. So in that case, collectability is uncertain, you should not recognize the revenue. Number 1 is collectability. Number 2 is all the performance relating to that condition should be satisfied. That is, seller must have the right to payment, buyer has the legal title, possession, etc, etc. That means ideally, logically, you should be able to receive that thing. Now there are certain special situations, what I called, which is basically 4 special situations, 1 2 3 4. In each situation we'll be understanding what we are supposed to do. Okay, the first situation is long-term contracts. In case of long-term contracts, you will always recognize revenue. Long-term contracts means more than 1 year. That means your contract will run maybe for 3 or 4 years, generally real estate. Okay, so in that case, we have also solved an example. I'm not going to redo that. Again, you can check the maybe whatever the book you want to, but this is example something which we solved. I'm just giving you the formula, that is that is how you will calculate it. Okay, so for every year when you will calculate the revenue, you will do what? Progress made towards the contract completion is equal to total cost incurred till date divided by total estimated cost to be incurred into 100. So basically it is same as percentage completion method, which was there in the previous accounting standard, but now they have not using the term. So percentage completion method, it is same as that. That is how much percentage of your contract is completed, recognize revenue in line with that. However, they are not using the term, so you are also not supposed to see that term in exam, because the term is not being used by the accounting standard body. But the concept is very simple. Suppose if your cost was, total estimated cost is 100 and you are incurring 80, so 80% of your contract is done, so automatically you will recognize the contract basically for 80% of the revenue you will recognize. Okay, next, second situation is when consideration is variable. So when it is variable, as per standard, revenue should only be recognized when it is highly likely that it will not be reversed in future. When consideration is variable in terms of, suppose there is a bonus element. If you do, in all real estate contracts, what happens is that you have to do this build, you have to create this building in 5 years, you get 100, but if you create it in 3 years, you will get 120. That 20 extra is the variable basically. Now that variable, they say when it is to be recognized, rule says that you should only recognize it when it is highly likely that it will not be reversed in future, when you are pretty sure of. You don't need to judge this thing because exam will say you whether you have to do that or not. Third is contract modification. As per contract modification, how you will deal with that? The extension of existing contract or as a new contract, there are two situations. When you will treat it as extension, and when it is a new contract, the entire story starts again. You don't need to worry about that. But the problem arises when it is extension of the existing contract. In that situation, cumulative catch-up adjustment is required to be done on the date on which the modification is made. What is cumulative adjustment? Revised revenue, revised cost needs to be calculated, and then you will need to calculate the revised amount of differential amount of revenue that should be recognized. Okay. Next is acting as an agent. If you are acting as an agent, then then it is clearly said you will only recognize the net revenue that is receivable to you. Suppose you receive $10,000 per movie and your commission is only 10%, and balance you will transfer. Suppose it is a book my show app, or it is a app which books movie. So this movie is getting running in multiplex. That app collects the money, cuts its commission, and pass it back to the theater. So in that case, the only commission part should be recognized as revenue, not the entire part. Okay. Disclosure requirement is something you can check. Now second part, the third leg of this particular reading is expense. Expense means outflows plus depreciation plus losses. Okay, then you follow the matching principle concept. What is matching principle? Revenue cost of all associated revenue should be recognized. Suppose if you are recognizing a revenue, then to earn that revenue you must have incurred certain cost. All those costs should also be recognized in that same period in which revenue is getting recognized, so that you can get a true picture of net income, which is called the matching concept. Okay. Can all expenses be perfectly matched to associated revenue? No, there are period costs, so automatically you will not recognize. Period cost means time basis cost. Okay. Inventory is something which we will do it later. Depreciation is something which we will do again later. What is depreciation and amortization is something which you should know. I'm not going to explain that part. Okay. Different times nomenclature, depreciation, amortization. This is also something which you are supposed to know. Depreciation is only for tangible. When it is intangible with finite useful life, then amortization. If it is infinite, then impairment. If it is a natural resource, the terminology is depletion. Okay. Then doubtful debt and warranties. Doubtful debt and warranties is something which is bad debt. So a percentage of bad debt is calculated, and what you say, you create a provision for bad debt. Basically, you create a provision for bad debt. Analysis purpose is that management has some room for play in the warranty, provision for warranty or provision for bad debt. Like they can try to increase or decrease net income, reported net income, by changing the percentage of provision for bad debt. In this situation, you are supposed to know and you are supposed to recognize that. As an analyst, you should check whether the justification is viable or it is not viable. Okay. Next is discontinued operations. It is very simple. It says that whenever there is any what do you say, whenever there is any part of the segment of the business that is announced as a discontinued operation, in that case the measurement date and the phase out period should be clearly called out. That is, the measurement date is the date on which the entity formally lays down the plan to dispose of, and phase out period is the period during which it will be disposed of. And from that period, it should not be shown as a continued operation. It should be shown as a discontinued operation. Discontinued operation means you will show it as a single line item below the net income. So you will not include the revenue and expenses of those segments in that particular thing. Okay. Analytical implication is something because of when forecast, you should basically check how it is going to happen. Okay. How when you eliminate this segment, then projection needs to be made accordingly. Unusual and infrequent items, again the treatment is same. It is extraordinary item, you can show it on the lower side. Changes in accounting policies, accounting estimates, and prior period item. So there are three ways to deal with that: prospective, retrospective, modified prospective. Okay. So if change in accounting policy is because of change in accounting standard, just like just like this accounting standard change, if this is the reason, then all the three options are available, because change is happening because of government or the entity. or the accounting standard body. But if management opts to change their policy, then they will have to do it retrospectively. That means since the day the that element is existed, from that day you have to keep on revising your accounts, and automatically you will have to change that particular balance sheet for the current year. Okay, you have to revise everything basically. And change in accounting estimate is basically adjusted prospectively if it is an accounting estimate. Lastly, if it's correction of prior period item, then you have to do it retrospectively. Okay, modified retrospective is the term which is newly introduced, so you should take care of that particular